The economy is running hotter than expected on growth and on inflation and on the labor market. And the Fed's loosening of financial conditions from the November period last year through the beginning parts of this year really had a major impact on the real economy and kind of made it more difficult for them to achieve the last mile of returning inflation to 2%. So the market has moved, right? We came into the year expecting 6 rate cuts. The Fed was at 3. The market has taken that out, took it down to 3, and now subsequently has taken out even more cuts as the data has continued to come in better than expected. And the Fed itself has started to move on the March meeting. Even though the median dot didn't move, the mean dot moved higher, less cuts for 2024 and cuts out of 2025 and neutral rate moving higher. So there's been some momentum. And then when the data came in for the month of March in early April, Powell left us with some parting words before the blackout period, basically saying the next move is it's going to take us longer to determine that a cut could be coming.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
So, this is the way the Fed moves. They move methodically, they never move on a dime, but this is how they move. And so I think we're at a point now where the Fed is, really boxed in. They're not in a position to be able to start a rate cutting cycle. The data just is just better than expected. We got some more data today for 1Q GDP and 1Q core PCE quarter over quarter and personal consumption. And the aggregate of that data looks like core inflation tomorrow for the month of March may come in as high as 0.5% month on month. That's what some of the estimates we're looking at. Only yesterday, people were thinking it was people were expecting 0.3. And so because the data we got today, we've seen a revision higher of those expectations to possibly as high as 0.5. Morgan Stanley was at 0.48. So, but these numbers are just way too hot, and they show a very significant reacceleration from the trough in inflation of, let's say, November of last year. And so the market is moving rapidly. The bond market is moving rapidly and saying Fed needs to do more in order to bring inflation down. They need, and what I've said is they need to introduce a dual-sided outlook. And so the odds of them hiking need to be equivalent to the odds of them cutting as the next move. And I think the asymmetry that they've had to date, which has basically had the bar to cut being much lower than the bar to hike, has been self-defeating. It's made it more difficult for them to get inflation back down to 2%. So we're moving increasingly in that direction. I think the data we got today and again for tomorrow, I think is going to push us further in that direction. Next week, we'll have the ISM data, which, look, the flash ISM data was not great.
Before we go to the ISM, real quick, just on that comment, it reminded me, you had mentioned financial conditions, very, very loose, obviously. Fed swaps, you had mentioned in your channel, just got priced out any cuts until December. So we're really unwinding that. And yet the market really hasn't sold off that much. But on your financial conditions comment, I read a quote, and it was pretty cool by Goldman Sachs. Quote, our economists see the SPX performance accounting for 65% of the year-to-date easing in financial conditions. So you've also said, or we need an equity correction.
Yeah.
So this is clearly, they're still making tons of money on the asset appreciation in equities, and that has contributed to the loose financial conditions.
Yeah.
Obviously.
Well, and the Fed has also said not necessarily just to look at equities, you have to look more holistically at the whole economy with respect to financial conditions. Their own indicator has the Dow in there as one of 7 indicators. And so, yes, it's part of the Fed's view on financial conditions, but it is not the entirety. Goldman Sachs has their own indicator. And clearly S&P is a bigger part of their indicator than others. But the Fed has its indicators too, where stocks are not as important, although they are a factor. There is still looseness in financial conditions, even with the backup in the bond market that we've seen over the course of the last several weeks. And so conditions today just are not as tight as they were back in October of last year, when Yellen orchestrated a pivot and Powell orchestrated a pivot. We also, back then, inflation was moving in their direction, right? We were coming in with monthly prints that were suggesting that inflation was going to get back to 2%. People had been complaining that the readings on a 3-month annualized basis were as low as 2% or had a one handle. Why is the Fed still, now it's different, right? Now inflation is moving in the wrong direction.
But we also went from 4,100 SPX back then.
Yeah, it's a 55. Yeah, for sure. So we've moved incredibly. The stock market as a financial conditions index component is important because, for one, stock market gains are part of the wealth effect, right? I mean, people who are feeling
right now inflationary.
Right. And so, and the other thing too is it does filter into PCE because these portfolio management fees get paid out based on the values of accounts, and if the values of accounts are higher, that's part of inflation. So I know there's a lot of people who complain about this data and it's reflexive, but people are paying more for services. And services are not getting back down to 2%. And the Fed thought they could thread the needle and engineer a golden path, immaculate disinflation. And it's wrong. They were wrong and they can't do it. And so they now are retreating and are basically out of the accommodation business, I think, for this year until and unless the labor market deteriorates rapidly, which still doesn't seem like it's happening. I know I see the WARN notices. I see the big tech layoffs. I know there's some of the states don't look. Overall, the labor market still is good. People may be working 2 and 3 jobs. I get it, but and consumers may be struggling. But labor is still pretty tight and not showing that. Look, government jobs are up, construction jobs are up. We have housing shortage, right? So we're not going to see a rapid deterioration in the labor market. I think that puts the Fed out of play for this year, and so that leaves Treasury as the only real source of liquidity now, unless things really rapidly deteriorate on the labor front. And so Treasury gets to make some decisions next week. We'll get into that. But as far as the data, again, concerned, tomorrow is PCE. I think that's going to come in hotter than expected. And then next week, PMIs are on Wednesday, payrolls are on Friday. I suspect we're going to continue to see an economy that looks pretty good and makes it impossible for the Fed to deliver any accommodation. Fed meeting is next Wednesday. Obviously, they're not gonna cut. I think they're gonna basically also probably rule out June as a cut.
Oh, well, I was going to say
June as a cut. I don't think they're going to announce QT at this meeting. I think they're going to say they're still talking about it and likely would announce it at the next meeting. I think that's how folks who are looking at the minutes and the speed with which certain language in the minutes would suggest that. So I mean, look, it's possible that they could announce a tapering to QT at this meeting. I think it's more likely to happen in June. But the reason they're doing that is that they want to get the balance sheet down to an even lower level. They just don't want to have a financial accident between now and then. And there's an uneven distribution of reserves in the banking system. Some banks are way worse than others. And so the Fed is basically just saying, we just want a little bit more time. And ultimately, we don't want to cause an accident, which I understand. Look, the RRP has been building back as I expected off the lows on the 15th. We're up another 10 or so today, where I think we're up 125 billion from the lows. I think RRP is not draining to zero while the Fed is doing negative bills issuance. So the RRP is not an issue for the next 2 months, maybe even the next 5 months. And so I don't think there's a rush for the Fed to start tapering at this meeting. I think it would make more sense at the next meeting, but that's possible. But other than that, I think Powell is likely to kind of deliver we were wrong on inflation. We're a little bit more worried. There's upside risks. We're seeing it, and we're going to bring inflation down to 2%. And I think if he's asked about the potential for a hike, I think he's going to have to say that it's on the table, right? Like he has to say it's on the table.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.